does the operator really understand how to drive profit in the business? Because you'll find they'll promise and be like, oh, we can do this and do that. What is their experience truly driving profit? So that one particular policy, I put in $2,000 a month or $24,000 a year. Right? So I'm still adding to that policy. So as I add to that policy, I increase my capacity to borrow money. Make sure you get crystal clear on your investor DNA. Invest in things that are in alignment with who you are internally.
Welcome to the Legacy Syndicate Podcast. Today with us, we have Perry from Cash Flow Unlocked, and he has such a really cool story. What they are doing with his team is amazing. They are focusing on financial strategies, how to unlock more cash flow, investment opportunities, fractional CFO work, the type of things that really are going to take you to your next level as a seven-figure business owner. And I'm just so excited to have you here today with us, Perry. What started this journey of becoming a financial strategist? Like, tell me where you started and how you got to where you are now.
Absolutely. Thank you, Julie, for having me. So I'll try to keep the story concise because it's actually a 20-year journey.
I bet.
So we'll keep it short, to honor the time frame that we have available with each other today. So long story short, I got into the financial service industry as a stockbroker back in about 2003. Was when I started that journey, and came into the industry as a traditional financial advisor, wealth manager, planner, whatever you want to call it these days. And was in that place for, probably 15 years or so. And then around that 15-year mark, I ended up branching out on my own and started my own firm, an investment advisory firm. And I started to realize at that point in time that the strategies and the methodologies that I was taught coming into the industry from a more quote unquote traditional sense wasn't really helping the clients that we were working with. And at that point in time, when I went independent and started my own firm, a lot of our clients were those entrepreneurs. And what we started to really get our head wrapped around, Julie, was these entrepreneurs didn't need, a plain vanilla 401k plan to create wealth. They didn't need, the IRA.
Yeah.
A lot of their challenges were coming in from like, man, do you know how to manage your cash flow? Are you reducing your taxes? Do you know how to drive profitability? So at that point in time, we started to make this pivot into what we, at that point in time, the branding was called the Entrepreneur CFO, right? And we started to make that pivot. We started to help those clients implement the Profit First methodology. Big shout out to Mike McAllowitz and the team over at Profit First. So I'm a mastery Profit First professional. So I coupled that with that, traditional financial planning, if you will, with the investments and retirement accounts and insurance products and what have you. And then at that point in time, we started doing some fractional CFO work. Well, how we've evolved since then was, hey, not only do we want to be able to work with those entrepreneurs, but also to work with some of those, high income earners as well. And I had this aha moment, if you will. And I know my team gets tired of my aha moments because it seems like I have an aha moment every 60, 90 days.
That's a good sign.
Right.
Every 60 days, your team's like, oh, hang on.
They're like, here he comes.
Here he comes. Trajectory shift.
For sure, right? And the aha moment I had was, man, when I started doing CFO work and you started to, with CFO work, you really focus on the profit and loss, right? The cash flow statement, the balance sheet, how to create cash flow, how we can create profitability, right? How can we leverage and get access to capital to scale and to grow? I'm like, well, why don't we just use this for people's personal finances? Like, why are we overcomplicating this? If this works for the corporations, if this works for the banks, why don't we start to, quote unquote, think like the bank, right? So we moved from the traditional financial advisor, where when people hear financial advisor, some of the first things that come to their mind is, IRAs and Ks, unfortunately, commissions and things of that nature, right? They're like, oh, he's going to try to sell me something and make a commission, right? So we transitioned from that financial advisor space into this financial strategist, right? And we started working with clients and just let them know like, hey, our goal is to come in and give you financial strategies that are not only going to make your business profitable, but also put you in a position to actually become work optional. And so we started to focus on, hey, in order to be work optional, versus retirement. Because when we hear retirement, we think, oh, you got to work till age 65. I don't want to work till age 65. So why in the world am I teaching strategies or concepts that's going to have you working to age 65? I don't want to work till 65. So we started to put together this framework around, hey, financial freedom is the point in time when your passive income is more than your monthly expenses. Well,
Yep.
guess what? We can help people become work optional at 30, 40, early 50s, right? You don't have to work till 65 unless that's what you enjoy doing. So that's why we call it work optional planning. So now, we wear the hat and the title of financial strategist because that's more in line what we do. We have clients who come to us and we might not even recommend a stock or a mutual fund, right?
Right.
Their jam may be, we call it these 4 millionaire mountains that we learned in the book, The 1 Minute Millionaire. Those 4 millionaire mountains are real estate, entrepreneurship, infopreneurship, and your traditional, non-traditional investments. So based upon our clients, investor DNA, we then from there put together the strategy for them to become work optional as quickly as humanly, or I should say mathematically possible, right? So that's how we evolved into this new space of financial strategist versus financial advisor.
That is absolutely incredible. And I love that because when you come up to a financial advisor, right, they might be working with loan brokers, insurance brokers. They are getting a commission on that. They're thinking it's the best thing. And it's like they're educated just on a few methodologies. Whereas you guys are coming in and you're literally looking at their business and you're like, well, you can do stocks, but I don't think this is best based on where you want to go with your company. Like, for example, great question that a lot of people come to me with is like, how do we set up financial strategies for cash flow so that we can invest in the down payments for real estate, right? That's a really great question.
That's an amazing question. Are you asking me that question? Because
Yes,
I'd love to answer
absolutely.
that one. Okay, outstanding.
Yeah.
Right. So one of my favorite questions, because we're real estate investors as well, right? So how we go about it, we implement the concept called D banking. And I forgot when I first heard this concept, but the idea of 4D banking is you typically have four asset classes that if you leverage them appropriately, you can get access to working capital. Working capital, I mean loans, lines of credit, things of that nature. So if I was to give just a real life example here, my wife and I just closed on another rental property last week. And
Nice.
thank you. And how we close on that rental property is we use the infinite banking concept, right? So IBC. So IBC, Rockefeller Fund, Bank on Yourself, whatever it's called or wherever you hear it, right? What it simply is using properly structured, optimally funded cash value life insurance, right? So we were
So,
able, go ahead.
so is this where you take the life insurance and then you take a loan against the life insurance?
Yeah,
Okay, so
absolutely.
that's oh, okay, keep going.
Yeah. So we funded, check this out. We funded the cash value life insurance with the profits from the business. Our monies are now inside this properly structured policy. And when we say properly structured, a properly structured policy should give you cash value anywhere between, let's say, 75 to we seen as high as 88 of what you put in. So if you put in $100, you should have 75 to $88 available as cash value. Okay. So we're using the profit from the business to fund the policy, right? Our monies are growing uninterrupted. It's earning a better rate of return. It's sitting in some of these sorry savings accounts that's earning less than 1% these days. And then when it's time for us to, I call it in layman's terms, time for us to bust a move, or, or hey, it's time for us to invest. We can continue to let our money grow uninterrupted inside that policy, use the policy loan. So we're still not even using our own cash. We're just using our cash as collateral to get that policy loan to then go out and fund, I tell my wife, let's go shopping for passive income. So we literally just ran that transaction here recently. We had 24,000 in cash value sitting inside this one policy. We needed about 18,000 down payment on this rental property. I was able to go in, request that loan, get access to those funds in less than 24 hours. And then we brought that to the table as our down payment. So pretty much a no money out of our pocket deal, right? Because our cash value is still sitting inside the policy, growing uninterrupted, and we still had access to capital to still go out and shop for passive income.
So you
So
guys literally are having two sources of cash. One is still creating interest. The other one is put towards the loan. And
apps.
then is the amount that you have on your insurance policy, is the limit of the loan related to how much is in the insurance policy, or is it related to how much you put in every month?
Absolutely. Great question. So it's kind of, let me answer the first piece. Yes, absolutely correct. We're making money in our right hand pocket and our left hand pocket. So we don't have the anxiety that a lot of investors have or entrepreneurs have when it comes to investing in businesses or real estate or whatever the case may be, because that anxiety is like, man, I have to take the money out of this account and put it over here. And if things don't work out, then I lose that money, right?
Cash flow management.
Absolutely. We don't have that anxiety because the money is still in the account earning interest, and we're using that as collateral to get access to capital to then go out and do the investment piece, right? So yes, spot on. You're making money in your left hand and your right hand pocket. And with respects to, how much we have available to us is how much you're putting into the policy and how it's structured, right? So that particular policy, and I think last time I calculated, we have probably between my wife and I 9 policies. So that one particular policy, I put in $2,000 a month or $24,000 a year, right? So I'm still adding to that policy. So as I add to that policy, I increase my capacity to borrow money because I didn't even use all the loan that was available to me. I only use 18,000 of what was available to me, right? So I still have funds in there if I want to borrow against. And as I add to that policy, I continue to grow my capacity to then go out and do other deals.
Wow. Well, that makes sense because, you're putting in 24,000 once a year. It's adding up. You're having interest accruing on it. And then whenever you're ready to reinvest, you can take a loan out. Now, can you take multiple loans out on a insurance policy, or is it better to have a couple different insurance policies that you're running with?
You can have multiple loans outstanding. If I was even to log into my policy right now, Julie, and be like, hey, I go in there and be like, yep, you got $3,000 available. I can request $1,000 today. I could go and request another $1,000 tomorrow on that particular policy. So you can have multiple loans outstanding. And I want to make sure that, your listeners really kind of grasp this concept of the infinite banking piece. And there's other ways that we bank as well. And I'll get into some of those. Since we're talking about this particular scenario here, right? There's no origination fees. There's no closing costs. I didn't have to come up with any type of tax returns or proof of income. The insurance company is more than happy to lend you that money because they know they're going to get their money back, right? So let's say a policy loan was for 18,000. Well, here's the deal. The cash is sitting in the account so they can see the cash. And let's say that from a cash management standpoint, because it's still a loan, at that particular loan, my interest rate is 5.1%. So it's accruing 5.1% interest. If I choose, and I'm not advocating this, but just painting worst case scenario here. If I choose to never pay that loan back, the insurance company is not tripping because what they're going to do is when I die on that particular policy, death benefit is about $900,000. When I die, instead of my family getting the $900,000 tax free, they're going to get whatever the principal and interest of my loan is minus that. So let's say in 20 years, it's $30,000. Instead of my family getting the full $900,000, they would get $900,000 minus $30,000. So they would get $870,000. Still a win-win. So now I have access to capital without even having stress of, I got to cover this debt service or this monthly payment.
Wow, that is phenomenal because with any investment strategy, you're really banking on and you're theorizing your hypothesis on whether it's going to be a successful one or not. And you have your previous experiences you're going through. Maybe you've done flips and deals. Maybe you've done wholesaling. Maybe you have experience in that. But then there's still that element of risk. And then also, how you're dealing with the loans, how you're doing that. And honestly, 5% interest is not bad considering that a lot of loans nowadays you're looking at, well, it depends on which ones you're going for, but the SBA is pretty astronomically high. Like you're talking 30, 40% depending on what you're looking at for loan interests.
Absolutely, right? So you have a loan with a very reasonable interest rate. You have what's called a non-structured loan. Non-structured means you don't have a required monthly payment. Yes, I'm paying 5.1%, but I don't get a monthly statement every month saying, hey, this is your loan payment due. Don't get that at all. You self-manage that internally, right? So as cash flow comes in, or in this particular deal, we're going to go into this deal, we're going to renovate it, then we're going to rent it out. And then after we rent it out, we're then then going to go put a mortgage on it and pull our cash back out. And then we'll pay off that loan and go on to the next deal.
Wow, that is very seamless. And I was really excited when I saw your experience level. And before our podcast, our conversation, I was like, I got to ask him this question because a lot of people are, they're like, I have a lot of people that are making, 5 million, 6 million per year. And they're coming to me and they're like, oh, what loan should I get? Where should I go for this? And then, they go in and it's like, yeah, you don't really want to take out like a SBA loan or some of these other loans to invest in real estate. Like that's not the best way to do it, right? And there's different ways to do it,
Yep.
So, and there's even like syndications too. And you mentioned you had experience with that as well.
Yeah. And before we even go into the syndication piece, I'm going to share one more strategy with your audience because we use this one pretty heavily as well. Another strategy we use. So to your point, hey, business owner, you are killing the game. You have a 7-figure business, right? Cash flow is pretty strong. You're able to pay yourself, but you want to expand, you want to scale, right? So not only do we use the infinite banking piece, but part of that 4D banking concept, is we use what's called S blocks, right? And that is short for security-based line of credit. Okay. And I first started using these almost 20 years ago when I was with a pretty large firm at the time. We were a Swiss firm. At the time, we were the largest wealth manager in the world. We managed about $3.2 trillion with a T. And I was like the only advisor at the firm who was really using these lines of credit. Because I was like, well, hold on now. You're telling me that if a client brings me their portfolio, and their portfolio could be stocks, mutual funds. It could be just straight cash for business owners that have cash sitting in the bank. They could bring me that cash or those investments, bring it in, and we be the custodian. And no origination fees, no closing costs, a soft credit pool just to make sure they're not crazy fraudulent, right? And we'll give them a line of credit anywhere between, let's say, 60 to 90% of the value of that portfolio, interest only. I said, why aren't we using more of this? Well, I was a young advisor at the time, right? And I didn't have a whole bunch of, millionaire clients that I could go to, right? So I couldn't go and say, oh yeah, I have a track record of getting people 10, 12, 15% over the past 20 years because I was still a baby in the business. But by that time, I understood financing. I was already in real estate. So I did millions of dollars in these lines of credit. And we still do those lines of credits today, right? So for that business owner, even if they're not looking at the infinite banking piece, which is the same strategies that the banks use to store their cash so they can have access to capital, with the security-based line of credit, right? If you have cash, we just helped a client here. They had $200,000 sitting in the cash account for the business, right? And I said, what you earning on that cash? It's like, Perry, like 0.5%. I said, that's pathetic. And then it came to it like, man, Perry, I'm going to do some real estate. I said, well, shoot, bring us the cash. Our money market fund at the time was paying, I think, 5.5%. I think it's down to like 4.2% now. Still better than that 0.5%.
So you found the money market account stuff too. That's amazing.
Yeah. Heck yeah.
Tell us for the audience, like, if you don't have a money market account, guys, you guys need to switch over.
Oh, for sure. Yeah. So they brought over the 200,000 because it's still sitting in cash, right? Because it's still the business cash. We were able to get them a line of credit at 90% of that. So we got them a line of credit for $180,000 in less than a week. They just, hey, Perry, we went about bought 2 properties. That's amazing. And it's an interest only. So the debt service is super minimal on that, way less than they would pay if they had, did a traditional mortgage on it. And it doesn't report to their credit bureaus. So it doesn't even touch their debt to income ratio. So they're like, Perry, this is crazy. I said, you're welcome. Right. So yeah, we love that jam. So those 2 are like 2 of our favorite of the 4D banking piece. And to your point with the money market funds, right? At the banks, you have checking and savings accounts, right? And again, I know some banks that are like, if we were to go online and say, hey, let's see what their savings account is paying, like 0.01%. It's pathetic numbers, right? So you got checking and savings accounts at the bank. But when you deal with an investment professional, they're going to have access to what's called money market funds, not the same as a money market savings account. Those are at the bank. Money market funds are with investment professionals. Still a short-term cash interest instrument, if you will, right? Still going to feel like that money market account that you have at the bank, but typically it's going to get a higher rate of return or higher interest rate, but still very liquid. And in our case, our clients love it because it's a great place to store cash and sleep at night. But then we give them that security-based line of credit on the back end, and they can go out there and, as we said earlier, go out there and bust a move and do something different with it.
Wow. Wow. I mean, this is really, really great stuff. Our audience and myself, like this is amazing stuff because like it's all about the setup. You know, it's all about intentionality. It's all about being strategic, right? And a lot of people just jump the gun because they get so excited. They see a property, right? And they're like, well, it's going to go off the market soon. You know, this is like the best deal, right? And you know, they put all their cards in the wrong bucket. I mean, I've seen it happen. So
Yeah. And
it's all about being strategic.
And Julie, I'm so glad you brought that up, right? Because with respects to being strategic, and I won't go into the full conversation I had in the hot tub this morning with one of my colleagues, right? But we were talking about, I did a podcast episode here recently about should you play offense or defense when it comes to your finances, right? And really you want to play both, but you want to be able to play defense first because in my mind, being a former college athlete, right? Defense is so important because you got to be able to, defense in my mind gives you more at-bats. It gives you more possessions. It puts the ball in your hand more often. You still got to know how to score, right? So you still got to know how to invest and increase your financial literacy around that piece. But if you can mitigate the risk and know that these funds that I've worked really hard for, I've bust my butt to get this cash reserves up by running my business and saving and things of that nature. When you have the peace of mind knowing that that is still intact, and then you can use somebody else's money, right? So that OPM concept, use somebody else's money to then go invest in something that may have some risk to it, right? It just allows you to be a more, to your point, strategic investor because you've mitigated the risk. Worst case scenario, you're not going to lose your principal, right?
Yep.
I asked a room one time, I said, how more aggressive would you be as an investor if you were using my money versus yours, right? It's just it's a different mindset. It just opens up the floodgates to become a more active investor. And you start looking for opportunities because you're like, you know what? I can do that. We have, $300,000 to go shopping with other people's money. Let's go shopping.
Yeah. And just that level of opportunity and that level of like really just having that abundance mindset, right? You've instantly upgraded your identity. Like no matter how much you're making, you only have so much on hand to invest in. But if you've done this strategically and you're able to take out what you suggested, I forgot the name of the specific loan off of the credit, but
S block. Mm-hmm.
What's it called again?
S block. So short
the
for
S blocks.
Security-based line of credit.
So like obviously you're just opening up your lines of credit and you're able to just move so much faster, right? And money loves speed. Money loves speed.
Money loves speed. I gotta go back to something you just said right there. We could almost end this episode right now. I could just throw my mic on the ground. When you adopt that abundance mindset, it's a game changer when you move out of scarcity into abundance because you've mitigated your risk. Your eyes open up and you start to see opportunities you would never see before. You would entertain opportunities that you may not have even, thought were available to you because now you are being, as you already said earlier, intentional and strategic. So what's so funny now, we closed on that property last week. We have a cash out refi pending right now where we should be able to pull out, 20, 30 grand if things work out of that one. And we already know where that money is going to go. It's going into a vending machine route that we've been eyeballing here for the past, 90 days. So again, very intentional about, creating that passive income from a strategic standpoint. But you hit that nail on the head. That abundance mindset and being intentional and strategic, that's a formula for winning.
Yeah. And that was a great example you just brought up with the vending machine is you have this, you just don't have to think about it anymore. It's not even in your head. You're like, oh yeah, I know how to get the funds. I know how to move them. I know how to get the best deal for the best deal. And that makes it so much smoother. Because think about it, like it's almost like when you're transferring or trying to do a bank wire transfer or these kinds of things, they like start to slow down like your process and how fast you can move money, right?
Yeah. And you hit that nail on the head. You said money loves speed, right? We're able to close on deals so quickly. Like when we put in an offer on a property, it's not, hey, we'll close in 30, 60 days.
Right.
No, it's like, oh no, we'll close in 10 to 14 days. What's going to hold us up from closing won't be us. It'll be whether or not your title is clean and there's no liens on the property. But it won't be us because we can close in 10 to 14 days, right? Because everything is already set up.
So where do you think that places you in the marketplace as like what do you think the measure is against competitors that are also bidding on those locations?
Oh my goodness. Julie, it's a game changer, right? When you can go to a seller and say, hey, yeah, we can close in 10 days, right? Their
That's
ears,
fast.
right? Their ears perk up and they're like, well, I know, you know what? I got a better offer in, but they talking about closing in 30 to 45 days. If they're selling a property, they kind of need the money now. Typically, if they're
Mm-hmm.
saying, hey, we need the money now. Okay, well, if you need the money now, this is our offer and we will close in 10 to 14 days. Now
Like,
you can get a
what?
bet. They're like, man, yeah, we got this other offer over here, but they might not close for 30, 60 days and their financing might fall through. We don't have that issue. We're ready to go right now. I can give you a pre-approval right now from our online hard money lender, and I can show you our cash reserves. We will close in 10 to 14 days. So it allows us, I'm so glad you brought that up. It allows us to move quickly. It allows us to move with confidence, right? Because again, we're leveraging what we've done already. You know what I'm saying? Our savings and our relationships, and we know we just move faster on the deal. And in the marketplace, investors or sellers love that, especially wholesalers, right? Oh, you can
Oh
close
yeah.
in 10 days. Let's wrap this bad boy up. Put it in contract. Let's go.
You're like, you have an edge in the marketplace, like, and then it's, yeah, I mean, all the way around, your process is streamlined.
Mm-hmm.
And buyers and sellers are going to see that, especially sellers, they're going to see that right away.
Yep.
Amazing.
Yep.
Wow. What a gold nugget drop. That was amazing.
I appreciate that. Just to kind of add to that, kind of what our entrepreneurs, and I'm a super transparent dude. Everybody listening, don't think I just rolled out of bed and knew this stuff. Like, I've taken my lumps. I've taken some many L's.
Oh, yeah.
I'm very transparent that, this is my second go round with real estate, right? My first go round was from 2000 to 2009, 2010. We all remember, when the markets crashed in 2007, 2009, the Great Recession, if you will. So this is my second go round, and I've taken my lumps on this bad boy. But because, I was able to, through prayer and also through some coaching and some mentorship, realize and be really thankful for that bad time that I went through in 2007, 2009, because it just equipped me with this level of expertise, understanding, and empathy that I can help others do things and be like, nope, don't do that. I'm going to tell you exactly, if you do this, this is what's going to happen. We don't want to do that. This is how we want to do it. Again, what I'm saying? I want to make sure that, your audience understands, like, oh no, I haven't been perfect with this thing. It's been a lot of trial and error, but we definitely got this thing down to a science today.
That's incredible. Yeah, and 2008, man, that's wild. So you had properties during that time?
Yeah. Like, it was so scary, right? So we got properties, we got hard money loans, we got our own money in the deal, and properties, the value started dropping so quick. One property dropped from 400,000 to like 200,000 in 30 days. We couldn't refinance it. The bank was like, yeah, because the value's down so low, yeah, you got to bring an extra $100,000 cash to refinance it. I ain't got that. Oh, it was it was a tough time. It was a tough time. I got all kind of stories I can share about that. Yeah, for sure.
Wow. Well, that experience is like, that's gold to have someone that, knows their way around real estate, knows their way around investing, knows their way around, cash flow management and how to put funds together and how to do this stuff, right? Because like, you would probably save someone, like, it depends on how much they're investing, but you'd probably save someone like millions of dollars easily by skipping all of that trial and error in the beginning.
Absolutely.
That unfortunately you had to go through, but fortunately you had to go through.
Right. Fortunately, it was part of my story, and that story led me to where we are right now from a financial strategist standpoint, right? And exactly that. It's one time I asked somebody the question. I was like, would you rather have someone advise you who's never made a mistake, or someone who's lost it all and had to make it back? And sometimes people are listening and be like, well, do I want the person who's never made a mistake? Because if we make a mistake, they don't know how to bounce back from it. You kind of want somebody who's actually been in the trenches, what I'm saying, and knows how to rebound from it, right? So yeah, so it's one of those deals. I'm always super transparent. Never want anybody to think like, oh my gosh, Perry's this, financial guru that
He's never made a mistake in his life.
Heck no. I'd have been up at night, stressed out, anxiety.
And we've all gone through it. That's the thing.
That's the reality. And even after you start making seven figures, you're still going through something.
It doesn't matter. Even if you're like at 20 million, 100 million, you're still up at night solving problems.
Tell me about it. Tell
Now,
me
if you
about it.
have a good, CFO like yourself, fractional CFO, or, you have a good CEO and you got a good team, you can mitigate some of those overnight worries, but they still come up,
They still come up. Still come up. When I was going through that Great Recession, 2007, 2009, my daughters, my twins, were born in 2009. So imagine the stress of the values of
In,
twin
in
girls.
2009.
Oh yeah. Oh yeah. Would you say perfect timing? Right. So it's like, no, now I have mouths to feed and the value of this property just dropped 50% and the banks aren't lending money and I'm hemorrhaging 6, 7 grand a month. What in the world? Oh, yeah. Like I can tell you all about sitting up at night, stressed out, not sleeping. And
Oh
I
my
get it.
goodness.
I get it. Yeah, for sure.
Oh my goodness. Oh wow. I don't know how to follow up after that one. That's deep, right? Because it's like all your levels of experience and like, just a short sentence here on the podcast, but like wow, that's incredible. Tell us a little bit about syndication if you want to for a little
Yeah,
bit.
yeah, yeah. I'll speak on a little bit because I haven't had an abundance of experience with it. But what I do like about a syndication, especially when we're talking to even our clients who are looking for opportunities to get passive income, when you're looking at a syndication, right? So you're looking at a business, right, that already has an operator. You're able to come in as an investor in this particular sense, right, and put some dollars into the pot, right, and hopefully get a return on it. It's one of those deals where, and let me tell you the challenges I've always had kind of in this particular space
Yeah,
is,
absolutely.
does the operator really understand how to drive profit in the business? Because you'll find they'll promise me like, oh, we can do this and do that. What is their experience truly driving profit? And then you also want to ask like, okay, who's also on your team? Because just because you're the operator doesn't mean that what buttons to push and levers to pull to drive the profitability. So I want to know who's on your financial team as well, right? Now the deal is if we can then analyze that deal and see where we can put some money in and earn that passive income, which is what we're always looking for. That's even the reason we even consider syndications. It's like, hey, I can put my money here and not have to run the business, but you also want to do major due diligence, not only on the operator, you kind of want to understand the business, not that you have to be a full expert on it, but you also too want to understand the team and their track history for delivering on that promise that they say they're going to deliver on, right? So we like it in the sense of, yep, this could make sense, but we walk in typically very skeptical because we see a lot of them, right? We get presented with a lot of opportunities like that. And we start to lift up that hood. And as soon as we get that, that gut feeling like, nope, don't like it. No, we're not moving forward with that one, right? So we've had the experience as far as doing the due diligence on them and things of that nature. We haven't found one that we're really comfortable putting our own money into. What we found, at least for us, is when businesses come to us and they're trying to raise money, we may go in from a partnership standpoint and say, hey, we notice you don't have that financial team in place. And if you're looking to raise money and you're dealing with savvy investors, a savvy investor should be asking, okay, I understand that you're the CEO, you're the visionary, but who's running the books? Who's running the finances? Who are you talking to help make those financial decisions? If you don't have that, then we may consider coming in for an equity position where
Mm-hmm.
we'll come in and get those systems set up so that when savvy investors come in and they're like, hey, I want to understand the business model. I want to understand the P&L, where the cash flow, how's cash flow set up, whatever the case may be. Now they actually you have that credibility and somebody in place to help drive that. So that's where we've actually kind of created our own model, if you will. We're like,
Yeah,
yeah,
no, that's actually very smart because
yeah, well,
I don't run across too many successful syndications. The last successful one I saw was they actually partnered with the government for halfway
okay,
housing, and they had 600 units in Las Vegas.
yeah.
They had an entire team just for marketing, entire team just for the contracting, the building, entire team just to partner with the government. And they got a lot of government subsidies to actually fund the rentals once they were filled for halfway housing. But it was huge. Like you had like 100 people on that deal just working that, just to get all of that together.
And that's what it gives you that level of comfort, right? Because it's like, okay, you have a team. You actually have marketing experts. You have financial experts. You have these relationships. You'll see some of those syndications come through and it's like, ooh, it's kind of you and this great idea and you're raising funds, but what's your track record, right? So I always tell clients, do your due diligence and even more importantly, listen to that inner voice or have a, CFO come in and Ask to see the numbers like, hey, we're considering investing. I need to see the P&L. I need to see your cash position, right? What metrics and KPIs are you tracking, you know what I'm saying, to make sure that you're going to, hit these numbers that you say you're going to hit. So sometimes you need that second set of eyes to come in. So that's where we find ourselves landing a lot is, okay, we'll come in, we'll put a fresh set of eyes on this, and then we'll give you our professional opinion on whether or not, if we like it or not.
That's amazing. I mean, because the other thing too is people have really big goals, right? And they might not be quite ready for it, or they might be completely ready for it and they're going for too small of a deal.
Facts, big facts. Yeah. You know what? That kind of leans into that investor DNA conversation, right? And the deal is, let me go. Now, I always try to give credit where credit is due. Big shout out to the crew out of Alabama, Wealth Without Wall Street. I've been rocking with them for a while. I'm part of their community. And they were the first people I heard mention investor DNA, and I don't know where they got it from, may have been from Gary Gunderson, because I know he teaches on that as well. But this investor DNA, Julie, there are so many opportunities to make money out in the world, right? What's best for you? Because everything ain't for everybody. Right. So when you start to really understand your investor DNA based upon your personality type, right? If you're a very detailed person and you want to know all the details and all of that, or you're a very non-detailed person, you just want to get straight to the bag or get to the money, or if, depending on if you fall someplace in between there, you like to run systems, just understand, entrepreneurs, as you're listening to this and you're looking to scale your business or grow your business, or you're even looking to, do some investing outside of your business, make sure you get crystal clear on your investor DNA. Invest in things that are in alignment with who you are internally. If you don't like to talk to people, you probably should not be investing in anything that requires you to talk to a bunch of people.
Yeah.
Yep. So same deal. If you like to crunch numbers, then find something where you can do that. If you're a systems driven person, then, maybe the franchise is more your jam, because you don't have to create anything. You just got to run the system. Everybody's wired differently. But what we found with the investor DNA and the personality assessments that we do, it just makes life easier. When we onboard clients, we do a personality test on them. And they're like, really? Yeah. I need to know who I'm working with here, right? Because based on your personality is going to tell me what is in what's in line with, what you want to get accomplished. Because I could bring to you 10,000 different moves you could bust, opportunities, but I'm only going to bring you the ones that's aligned with your personality trait. Let's just get right to it so we can be as efficient as possible.
That's really good point. Really, really good point. Because a lot of people, and it's the same principle when you're starting a business. Like, a lot of people get into the business because they're like, oh, I heard you can make fast money. Right. And then they start running it and they're like, oh man, I got to switch industries. I've made this successful. Now it's time to switch. But you can actually eliminate a lot of that just by really understanding who you are. The same thing with real estate. There's no point in getting 5 multifamilies and all of that if that's not who you are, and you don't, there's certain things associated with having multifamilies that's different than other different, investment types.
Absolutely. Right. Absolutely. You're spot on with that. And again, this isn't something that I knew 20 years ago. Wish I had. Right. But yeah, it's like, oh no, I don't want to do a whole bunch of the way I personally invest. My personality type on the DISC assessment is a D. That typically means no fluff, get to the point. Are we going to make money or not? The last 2 properties I bought that my wife went and found, I never saw them until the day we closed. And folks would be like, what? You didn't go? I didn't inspect it. I didn't close it. I saw the numbers. The numbers made sense. I trust my wife. And literally it's like, yep, I closed on a property. When we closed on last week, I didn't see it till after I had signed the documents. And she's like, you want to go see the house we just bought? Sure. Let's go see it. Okay. Yeah, that makes sense. Okay. I'm gonna go back to the office and talk money to some more clients. So again,
wow. So your wife knows you. She knows your assessment. She knows your style. And it sounds like she's very investor savvy as well.
Well, here's the wild thing. And she probably hear me. She's probably back there. I wouldn't call her investor savvy. So this is really good. Let's lean into this just a little bit. I had no idea where our conversation was going to go, Julie. I knew it was going to be good. I just didn't know where it was going to go. Right.
Likewise.
So my wife is not investor savvy. My wife is a retired massage therapist. One of the promises we made when we bought our home, I said, you need to retire. She had been a massage therapist 20 years. Her body was breaking down. And I said, you're done. We're done. Right. So she retired. We retired her at 40. after 20 years as a massage therapist, and then she spent about a year and a half trying to figure out what she was going to do with the rest of her life, other than hang out with me and work in one of our companies. So I came across this other online coach who was local, who did hey, we're going to teach you how to invest in real estate using the BRRRR method, so the whole buy and rehab and refinance and
Yeah.
all of that jazz, right? So I enrolled me and my wife into the course.
This is pretty awesome.
But hold on, I forgot to tell her I enrolled her.
Okay.
So yeah. So the day of the course starting, I said, hey, I enrolled us into a real estate investing course. She's like, oh, that's great. I said, yeah, it starts today. Here's the link. And she's like, what? So she wasn't very happy with me. You know what I'm saying? Now, she loves me enough. I know she wasn't going to divorce me, but she was not the happy camper on this piece, right? So I was going in learning stuff more from a review standpoint and understanding that things are very different, investing today than when I was investing almost 20 years ago. Right? So I still have to learn some new concepts and dealing with wholesalers and hard money lenders and things of that nature. But she was learning all of this from scratch. So I wouldn't say she's investor savvy.
She's learned it.
Yep. But her personality type is she gravitates towards systems and stability. So she learned a system. And I tell anybody, if you give my wife a system, like a recipe, she has this huge recipe book with, recipes from like decades ago from grandparents and great aunties and all of that. If you give her a system, if you give her a recipe, she is going to run with it. So she learned the recipe of how to invest in real estate using the BRRRR method. So we look for distressed properties where we can put some money into it, build our own equity, right? With the money we put into it, rehab it, rent it out, and then refinance it and then do it again. She learned the system. She learned the recipe, and she's been running with it.
Yep. That is incredible. That's amazing.
Yeah, but if we had her on here and you say, hey, Sarah, you know what I'm saying? I heard you're a real estate investor. You're investor savvy. She'd be like, investor savvy? No, you know what I'm saying? So she knows how to find them. She now has the eye where she can walk in and be like, yep, that's 10,000.
She knows what to look for.
Right. And then she comes to me and she's like, hey, babe, so I put an offer in. I'm like, oh, okay. What's the numbers? And then I'll plug it in, and then we get to offer. It's like, okay, cool. We'll plug it in, and all right, baby, you know what I'm saying? I should let them know we'll close in 10 to 14 days, and we'll go to the next one.
Teamwork makes the dream work.
Man.
So she's good at finding deals.
That's her jam. You know what I'm saying?
That's amazing.
Networks, and she knows how to eyeball them and be like, yep, it's going to take 40, 50 grand to get into this deal. And it's like, all right, well, what I asked her, I say, so what's your max offer? What you going to offer them? And she's like, well, the numbers say this right here, but I don't know if they're going to take it. And I'm like, it don't matter if they're going to take it. Our offer is our offer. If they don't take it, it wasn't for us. So we got to get into one deal where she was concerned about her offer, and they're like, oh yeah, we'll do that. She's like, wow, that was like $10,000-$15,000, below what they were asking for. Yeah, our offer is our offer. We know our numbers, and here we go. So she is a classic example of someone who's doing well in what many would think is a complicated process, because she has the system down, right? John, I don't know if it's a John Maxwell quote. I know it was in one of his books, but the quote, Julie, is, let me close my eyes so I can see it. Systems allow ordinary people to achieve extraordinary results predictably. So you ain't got to be the smartest, but if you can have somebody teach you a proven system, you can probably win.
If you're consistent and you follow the recipe to a T.
Follow the recipe. Don't try to put in extra sugar just because the recipe said this much. Just put that much.
Don't actually dump salt, and you'll come out okay.
Right. Exactly. Yep, for sure.
Amazing. Well, talking about systems, you have a system that you call Wealthy. Yeah. And what does that stand for?
Yeah. So this is just for context for the audience here. I looked at my finances probably 5 years ago, right? And I already kind of shared the story of losing everything in real estate and then having, twin daughters. And this was in a failed relationships, twin daughters, and then custody battles and court costs and just all of the things, right? All of the things that drain your money, losing your job, all the things that just drain your money. So I looked at my finances, I think it was probably about 5 or 7 years ago. And I said, okay, this is kind of disheartening. I'm advising people on how to retire, and I don't know if I can retire. How crazy is that, right? But, most financial advisors won't tell that with you because I think last time I checked, financial advisors are in like the top, like 5 groups of people who file bankruptcy. Let that sink in for a second.
It's difficult.
right? Let that sink in for a
You
sec.
got to understand business.
Oh, yeah, exactly. Exactly, right? So I looked at my finances and I said, man, I don't know if I'm going to be able to retire the way things look right now because it's never been a straight line. I lost everything, had to make it back. Lost everything, had to make it back. So I went through that cycle a couple of times and I said, well, this is disheartening. I said, but as I was looking at it, I was looking at it from a more traditional sense, right? I was looking at the size of my nest egg. I was looking at the size of my retirement account. And then I got exposed to a different concept. And I said, well, hold on now. The hell with the nest egg. I have phenomenal cash flow coming in.
Hang on.
A
Yeah.
20,000, 30,000, like a $20,000 month of us is a bad month. Like we're expecting to see 40, 50, 60, right? So I was like, hold on. I have cash flow. Why am I tripping about the size of my retirement account? So that's how I created this wealthy framework. It kind of came from that. So it's a bunch of systems that I pulled together into this one framework. So the wealthy framework the W stands for watch your numbers, right? So this is, hey, let's start to think like the bank, right? If we start to manage our personal finances the way a CFO would manage a Fortune 500, business finances, it's going to tell us a lot. So to watch your numbers is, hey, what is your personal P&L? A fancy way of saying budget. How much is coming in? How much is
Cash
going
flow
out?
management, profit and loss.
Exactly. P&L. What's left at the bottom, right? So understanding your personal P&L and also understanding your personal balance sheet, things that people don't think about when you're dealing with their personal finances, right? But we want to know those numbers. So the reason we want to know those numbers is we want to identify what your freedom number is. And if I don't say anything else that's going to really resonate with the audience, let this be it. You are probably closer to being financially free than you realize. You've just been conditioned to think that you need to have a large nest egg versus actually solving for cash flow. So the freedom number is this. Hey, what is your required monthly nut? Is it 2,000 a month, 3,000 a month? I'm talking about the necessities, not to eating out, not to traveling. I'm talking about
Yeah, what's your baseline?
what's your baseline? So if your baseline is 5,000, then we can stop right here and say, okay, how do you go out and create $5,000 in passive or semi-passive income? Because if you do
Smart.
that, you wake up January 1st, okay, my monthly bills are 5,000. I got $6,000 a month coming in. You're technically financially free at that point in time. Solve for that number. Don't solve for a huge nest egg. Solve for the cash flow number, right? So that's the W. The E is the emergency fund. But we don't really buy into the traditional emergency fund with the high yield savings account. The reason we don't like that is because if an emergency happens, that emergency fund can get wiped out to zero pretty quickly. You got 30,000 in your emergency fund and you get a $30,000 emergency, that emergency fund is now zero. We believe our emergency fund should be the Rockefeller fund. So leveraging kind of, if you guys read the book, Gary Gunderson's book, what would the Rockefellers do? We're looking at using the IBC, infinite banking concept, as the emergency fund, the same thing that the Rockefellers use, right? And the reason we like that as an emergency fund, it covers life's limits. Those limits are loss of job, illnesses, money shortages, investment opportunities, and life's transition. So those are the limits, right? So that emergency fund, a properly structured cash value policy, covers all of those. I lose my job, I can tap the loan. I get ill, you know what I'm saying? You can throw in a long-term care rider or a terminal illness rider in that bad boy. You got a money shortage, you can tap into it without having to worry about covering debt service, right? You get an investment opportunity, you can jump on it really quick without
Just
stressing
versatile.
about. Absolutely, right? All of the things. So that's the E. Our A is automation. What can we set on autopilot and forget it? During my tenure in working with different firms, at one point in time, I used to manage, multi-billion-dollar 401k plans. And I would listen to these people now and look at their accounts. Like, man, this is amazing. How did you get $250,000 or $1 million in this account? They're like, Perry, I don't know. I don't know anything about investments. Just somebody at the water fountain told me one day, like, hey, you should put 5% into your account. And I just did it for 20 years and this is what I got. It's like, so the A is, what do we automate and set on autopilot? So I'm not anti-stock. I'm not anti, retirement plans, right? I am anti-paying taxes and I am anti not knowing how things work. But if we can set some stuff on autopilot, now that frees up the capacity to then go do the things that's going to accelerate the wealth creation, right? So that's the A. The L is the leverage, which I think is the secret sauce, right? We talked about it
Leverage.
earlier with the 4-day banking. If I can make money in my left-hand pocket and then be able to get access to a loan or line of credit and not touch that money and use somebody else's money to go out and buy cash flow generating assets, well, that's the win-win to me, right? So that's that leverage piece in the 4D banking. The T is where you want to terminate your toxic debt. Again, I'm not anti-debt in the sense of like the Dave Ramseys of the world or the Susie Ormans and things of that nature.
You need debt to run your business to a certain extent.
Right. So when I look at debt, I tell folks, and this is what we teach them, is this. You've been taught that if you have, if you owe somebody's money, you're in debt. But in debt, technically, is if you have more liabilities than you have assets. I'm not opposed to having a liability on one side of my balance sheet, as long as that liability gives me an asset on the other side of my balance sheet. So
Right.
the property we just purchased, I have a $100,000 liability on this side of the balance sheet. The day we bought it, before it was even rehabbed, it appraised at $200,000. So that liability gave me an asset, which actually increased my net worth by $100,000 in one
Profit and
set.
loss.
There it is, all day long. Right? All right. So that's the what number I'm on. T.
Oh, you got T.
Yeah. Yep. So terminate the toxic debt. You know what I'm saying? So when we look at that, we want to get rid of the stuff that's not performing. The stuff that's performing, we're going to let the business or the tenants or whatnot cover that cost. The H is the hedging of taxes. So not tax evasion. We go to jail for tax, but tax avoidance. One of my mentors recently said that you pay almost 51% of what you make to taxes. And you hear that and you're like, wait, the tax rate ain't that high. But when you start thinking about all the taxes, federal income tax, state tax, city tax, county tax, sales tax, right? Property tax if you own a property, right? You know what I'm saying? Capital gains tax if you sell something to make money. It's like, oh, well, yeah. So if you can mitigate that number and get that down to zero, as close to zeros, and just so you guys know, I'm not just making stuff up here. David McKnight has a phenomenal book that we just absolutely love called The Power of Zero, how to get to the 0% tax bracket in retirement, right? So there are ways to actually position your finances to get to that 0%. So imagine if you make $100,000, have to work half the year, just to pay the taxes. What if you could put some strategies in place and keep that money in your pocket? You may not have to make more money. You just have to reduce your tax bill, right? And get down to that 10, 5, 15, whatever the case may be. So that's the H. And then the Y, after that system is set up correctly, now you can go out and start shopping for passive income. So the Y stands for yield, because I couldn't think of anything else that went really good to say passive income.
And then in yellow.
Yeah. Right, like how's this going to work? Right. So yield is now your finances are set up. Go shopping. Like when we go shopping,
That's the fun part.
We go shopping for passive income, right? Hey, what can we vending machine? Let's look at it. Real estate. Okay, let's do it. Oh, I can invest in this business. Okay, let's look at it, right? So now you go shopping, but it all connects with that W and that Y, because know what you're shopping for. If your freedom number is 5,000, then that's what you're tracking. Hey, I got 1,000 this month off of this deal. I got 500 off of this one. Every dollar counts as you're working towards freedom. But now, instead of looking at the nest egg and like, oh man, Perry said, hey, if I needed, here's the math real quick. If somebody comes to me and says, man, Perry, I need $5,000 a month. $5,000 a month is $60,000 a year. If we were using traditional financial planning guidelines, I'm going to say to you, hey, Julie, in order for you to get $60,000 a year, the financial industry says that you can withdraw 5% of your nest egg. Okay, so let's see what that looks like.
That's not much.
That means you need to have a nest egg of 1.2 million to give you $60,000 a year. It ain't a lot of people with a nest egg right now, 1.2 million. So I ask the question all the time, right? It's a simple question. I said, so I got a question for you. Not that either one of these are easy. Let's just call it what it is. Nothing is easy, but what is easier? Is it easier for you to take your skill set and your relationships and whatnot and go and create $5,000 a month in passive or semi-passive income? Or is it easier for you to save a nest egg of 1.2 million?
Passive income. So obviously, yeah.
Again, reprogram the mind to think like, yo, let's go get the passive. Let's solve for the cash flow.
Yeah.
That's my wealthy framework.
That is amazing. I love that. There's so much gold in that. And really, it's like if you take care of all the pieces, then you get to go shopping. You get to go look for properties. You get to the why.
Yep, absolutely. You get
Right.
to the why.
And the why is to build a legacy, to build, something that you're not just proud of, but your family, is taken care of. And you're literally making your wealth like double itself while you sleep. Like that's one of the goals, right?
That's it.
And then
mama.
be able to help people and impact where you want to impact.
That's it right there. That's like, again, I could just throw my mic on the ground. That's a mic drop moment again for you, right? Am I doing this because I just want to be like that dude sitting up in my office like, oh my goodness, I got $40,000 of passive income? No, I know with the passive income we're generating, I have time freedom. I don't have to ask anybody's permission to take my kids on an AU tournament like we did last week. I don't have to ask anybody's permission to pick my kid up. I don't have to ask anybody's permission to go date my wife on a soft Monday and be like, you know what? I ain't got no appointments today, baby. It's an admin day. You know what I'm saying? Let's go close on our property and let's go have brunch, right? It's the freedom to be able to do those things and move like that. So to your point, to spend time with your family or whatever it is on your heart to do, right? If that's volunteering, if that's, at the church, if that's volunteering at a homeless shelter, if that's teaching and mentoring or dealing with the youth, everybody has something special in them that they can bring to the world. But unfortunately, they're tied to a paycheck and they don't have that freedom. They have the prison of the paycheck or the W-2 or even in some cases like our entrepreneurs. Hey, you got a great business. You're doing 5, 6, 7 million, but can you not show up for 30, 60 days and the business continue to rock and roll, right? If the business shut down today, could you maintain your quality of life? So effectively, what we're trying to do is just help people become free, because if people have time to do the things that's really on their hearts to do, I think that makes the world a better place. So that's the legacy, the generational piece that we're trying to create.
I love that. I'm so in line with that. That's amazing. Like that's really what it's about. It's being able to create the freedom, the life you want. And I feel like all humans should be free. And if more people believe that they could be free and they follow the recipe, you can get there. And it's not just getting there. It's like you can thrive, right?
Absolutely.
So thank you so much.
I think that's a t-shirt. All humans should be free. Like there's a lot of levels to that. All humans should be free.
A lot of levels to that.
That's your t-shirt. Get yourself that t-shirt.
So thank you so much, Perry. This was an amazing podcast. All the details to contact Perry are going to be in the details of this podcast below. Thank you guys so much for watching. Please comment, ask Perry questions. Would more than be happy to have him back on the show, guys. Thank you guys so much, and bye for now.